One of the most debated topics in Canadian real estate investing for beginners has got to be cash flow. So many new real estate investors will decide whether or not a real estate investment is good or bad based on the answer to this single question. Will the property produce positive monthly cash flow? But what most beginner investors fail to realize is the real money in real estate does not come from cash flow. What's going on, everybody? My name is Nick Fife and I'm your local realtor in Guelph, Ontario with Royal City Realty. And in this video, I'm going to explain why having a positive cash flow property is not how you win big when investing in real estate. But before we get started, make sure you take a second to hit that subscribe button and like this video. All right, let's get into it. So as intelligent real estate investors, we are taught to only look for properties that produce positive cash flow. We are taught that properties that produce negative cash flow are bad. If the rental revenue does not cover the expenses and debt service, it's not good. And that's 100% correct. You absolutely need positive cash flowing properties when investing. Here's the problem. Most people, especially beginner investors, believe that successful investing is all about cash flow and nothing else really matters. That is bad. It's wrong and it's dangerous. Cash flow is important, but that's not how you win in real estate. Positive cash flow is the bare minimum requirement to have a successful income property. As a matter of fact, it should be assumed that you wouldn't even consider an investment that isn't cash positive. The real winnings in real estate come from having a long-term view, from thinking long-term. And here's what I mean by that. You might find a great little property, maybe a downtown condo in Toronto or a little duplex in Guelph, and you get all excited that the tenants are covering all the expenses and there's even a little cash flow left over every month. You're pumped, you're thinking success is mine. And then it happens, the unexpected expense. The furnace blows, the tenant decides they want out, the hot water tank leaks all over the finished basement, the roof leaks, the toilet breaks, there's a 50-year-old oil tank found in the backyard, and on and on and on. At this point, if you don't have a long-term plan for your investment, you end up wanting to sell. You can spend years trying to time the market, years reading books, months finding the perfect property, months running spreadsheets showing all your annualized profits for each potential investment. And then once you find the perfect property, you might spend another month or so finding the ideal tenant. But as soon as that unexpected problem happens, you'll want to bail. Your emotions are going to take over and you'll want out of the game. Why? Because you didn't plan for it. You were so sold on the idea of cash flowing real estate that you never took into account that to really make money in this game, you have to survive these unexpected events. The real money in real estate comes from time in the market. Cash flow is great and necessary, but the real wealth comes from surviving in the game for the long term. Each year the mortgage gets paid down a little bit more. Each year a little appreciation kicks in. Maybe some years there's no appreciation, maybe even negative appreciation, and then other years there's going to be tons of appreciation. The positive cash flow, is, if allocated correctly, helps you survive these unexpected events, but it's your emotional control that will allow you to survive the game. The positive cash flow pays for the bills, but your emotional control and long-term approach will get you the big money. By dealing with the hassles of unexpected vacancies or unexpected repair expenses, you're investing in the long term. And look, I'm sorry to kill your dreams if you thought this was going to be a cakewalk, but there's no get-rich-quick schemes in real estate. For the first few years, you have very little equity in your home. But with each passing year, your little bit of equity snowballs and gains more and more momentum, until one day that little bit of equity you had in your property turns into 25K of equity, then 50K, then 100K, then 150K, and so on. And look, don't get me wrong. On the days that you're ripping out an old toilet to replace it with a new one, you're not going to be thinking long term. You're more likely going to be swearing under your breath thinking this absolutely stinks. But because you planned for it and you manage your cash flow wisely, you know that in the long game, the equity you build will make it all worthwhile. Stress is to be expected. It's how you make money in real estate. So update your spreadsheets to add the anticipated stress level column so that you can plan for it, expect it, and maybe even welcome it.